If your Social Security check lands in a Chase account, a Bank of America account, or a Wells Fargo account, you need to hear what I am about to tell you before the end of this month. As of June 2026, the rules governing where your retirement money sits have shifted in ways that most banks will never put in their welcome kit. Most bank tellers will not warn you. Most customer service agents on the phone will not mention it. And if you are one of the millions of Americans whose birth date falls between 1943 and 1964, this is not a nice-to-know piece of news. This is a protect your last paycheck piece of news. I am going to walk you through the 3 hidden traps sitting inside America's 3 largest banks right now, the dollar amounts that are quietly leaving senior accounts every single month, and the one legal path the federal government built for you that bypasses all of it. I am not going to give you theory. I am going to give you math with the names and the cents so you can sit down tonight, look at your own bank statement, and know exactly where you stand. Before I do that, let me explain why you are hearing this from me and not from your bank. Banks make money when your money sits still. They make money when you forget about a small fee. They make money when an overdraft happens on a Tuesday and you do not notice it until Friday. The Social Security Administration does not have a team of people whose job is to call you and tell you which bank is charging you the least. The SSA only contacts you when there is a problem with your benefits, when they want to verify something, or when they believe they have overpaid you and want money back. There is no one in the system who is paid to protect your monthly check. That work is up to you and, if you let me. So let me start with the first warning, because it is the one that costs the average senior the most money over a full retirement. Here is how a major bank welcomes a Social Security recipient in 2026. You walk into a branch because someone told you direct deposit is faster than waiting on a paper check. A banker opens a senior checking account, hands you a debit card, and tells you there is no monthly fee as long as you set up direct deposit. You go home feeling good. You set up your direct deposit, and for about 12 months, everything looks fine. Then comes month 13. The bank's internal system quietly reclassifies your account because you did not hit the minimum activity threshold, or because the bank changed the rules on what active means, or because the relationship bonus expired that no one told you was a temporary thing. A $10 or $14 monthly maintenance fee starts appearing in March. It happens again in April, in May, in June. By the time you notice in July, you have lost $56 for the year, and the bank has counted on the fact that most seniors do not reconcile their statements line by line. Now let me put that $56 into real life for you. That $56 is 2 weeks of generic hypertension medication at the pharmacy counter. That $56 is 1 month of the cell phone bill you use to call your grandchildren. That $56 is the copay on the eye doctor appointment you keep postponing. None of those things feel huge on their own. But the moment you multiply $56 across a 10-year retirement, the math stops being small. 10 years at $56 a year is $560. 20 years is more than $1,100. And that is just one fee on one account at one bank. The reason Chase, Wells Fargo, and Bank of America do not advertise this fee in the lobby is because they do not need to. Their entire business model is built on the fact that fixed income customers do not switch banks the way younger customers do. Switching banks feels like work. It feels like paperwork. It feels like a phone call to a stranger. So the bank counts on your inertia, and inertia is where the fee lives. Wells Fargo, in particular, has a long public history of running into trouble over exactly this kind of fee structure. The bank has signed multiple consent orders with the Consumer Financial Protection Bureau over fee practices that hurt everyday account holders. None of that history makes the account free in 2026. It only makes the rules more confusing, and confusing rules are where seniors lose money they did not plan to lose. I want to pause here and give you the first piece of protective homework because I do not want you to walk away from this video with fear and no action. Pull out your last 3 monthly bank statements. Look at every line item. that's not your Social Security deposit. If you see a fee with a name like monthly maintenance, account service, or low activity, call that fee what it is: money that walked out the door because you did not have a reason to open a new account yet. You now have a reason. I spend my days tracking these codes because the SSA does not have a team dedicated to calling you and telling you how to save money. They only call when they want money back. The only way to stay in the loop before these 2026 deadlines pass is to be part of this community. Make sure you hit the subscribe button and turn on the bell, because once these windows close, your monthly check is locked in at the lower rate forever. This is the warning that makes me the most angry because it targets the exact day your money arrives. Social Security direct deposits from the SSA land on a specific day of the month based on your birth date. Mine, for example, lands on the second Wednesday. Yours probably lands on a Wednesday too, and the major banks have known this for decades. Here is how the trap works. On the day before your deposit, the bank lets an automatic payment, a subscription, a small medical charge, or the previous month's unpaid fee slip through your account. Your balance goes negative by $5 or $20, just long enough to trigger an overdraft fee. The very next morning, your Social Security lands. The negative is technically covered within hours. The bank would never need to send the transaction to a real overdraft program. But the fee, which can range from $30 to $35 per item, is already charged. And once it is charged, it is almost impossible to get it removed unless you stand in the branch and make a face. Now let me show you what happens when this pattern repeats. 5 overdrafts in a single month equals $175. 10 overdrafts equals $350. That is not a fee. That is more than half a grocery run. That is more than a utility bill. That is the difference between a senior paying for their medication this month or skipping Sunday dinner with their family. In 2026, the federal rules around overdraft fees changed after years of public pressure on the largest banks. Many of the mega banks now offer no overdraft fee checking, but only if you actively enroll in the program. The default setting when you open the account is still the fee. You have to opt out of being charged. You have to ask the banker on the day you open the account, will my account charge me if I am negative for 1 hour before my direct deposit hits? If the banker says no, ask for that answer in writing. If the banker says yes, ask what the dollar amount is. Then ask if there is a daily cap. Then ask if there is an annual cap. You should never be afraid to ask these questions. These are not nosy questions. These are the exact questions the Federal Consumer Protection Framework was built for. The law says you have the right to ask. The bank is required to answer in plain English. If they push back, that itself is your signal to take your direct deposit somewhere else. Bank of America, Chase, and Wells Fargo all have different overdraft policies in 2026. Some cap the daily total, some waive the fee if your account is brought back to positive by the end of the business day. Some only do that if you have a standing direct deposit relationship. The single most dangerous thing you can do is assume the policy you experienced last year is the policy you will experience this year. Bank policies change all the time, and the new terms are not mailed to you as a friendly letter. They are buried on page 47 of a updates to your account document that nobody reads. This is the silent killer, and it is the one the banks like to pretend does not exist. When your Social Security is direct deposited into a major checking account, that money loses a layer of federal protection for a brief window. Federal law is very clear that Social Security benefits cannot be garnished for most debts. The Social Security Act and the Consumer Credit Protection Act both protect your retirement check from being taken by credit card companies, by old medical bills, and by most private lenders. But here is the catch. The moment that Social Security money lands in a regular bank account and is mixed with other money, it loses some of that shield. Creditors who have a court judgment against you can ask the bank to freeze the funds while they sort out which dollars came from Social Security and which dollars came from your other income. This process is called an account levy. It is legal. It is paperwork heavy. And while the bank sorts it out, you cannot access your own money. For a senior on a fixed income, an empty account for 10 business days can mean medicine that does not get picked up, a refrigerator that sits empty, or a rent check that does not get mailed. This is not an abstract risk. It happens tens of thousands of times a year in the United States. The CFPB has flagged it as one of the unfair practices that disproportionately hurt older Americans. In 2026, the federal rules around how a bank must protect direct deposited federal benefits are more clearly written than they were in 2024 or 2025. Banks are required to flag the deposit, identify the protected amount, and leave it untouched for 2 months from the date of deposit. 2 months of protection. That means if your April 1st deposit is hit with a levy, the bank has to leave at least the last 2 months of Social Security funds alone. That is the good news. The bad news is that the rule only works if the Social Security money is identifiable in the account. If you let the bank lump it together with every other dollar, if you let direct deposit go into a combined checking, savings, and bill pay account, the bank does not have to sort it out. The creditor can ask for the entire balance, and the bank can hand it over. You then have to fight to get your own money back. That fight takes weeks. It takes letters. It sometimes takes a lawyer. You should not have to fight for your own retirement check. The protective move here is simple. If you keep your Social Security in a major bank, make sure it sits in a separate account that is used for nothing else. A deposit-only account. No debit card attached, no bill pay attached, no roundup savings attached, just a place for the SSA to push the money, and then a manual transfer out once or twice a month to the account where you actually live your financial life. This small act of separation is the single most powerful protection a fixed income senior can put between themselves and a surprise levy. Let me slow down here and give you the second piece of protective homework. Call the 800 number on the back of your debit card. Ask the agent, is my account set up to automatically protect my federal benefits from garnishment? If the agent says yes, ask how the protection triggers. If the agent says no, ask what account type would. If the agent does not know what you are talking about, that is not their fault. That is the bank signaling that they are not equipped to be the home of your retirement check. Use that signal. If you have made it this far in the video, you already know more about your own banking relationship than most frontline employees at these institutions know about their own products. That is not a brag. That is a warning. The information asymmetry between a bank and a consumer is real, and the senior is always on the losing side of it. The only way to even the score is to ask the questions no one ever told you to ask, and then to act on the answers. I spend my days tracking these codes because the SSA does not have a team dedicated to calling you and telling you how to save money. They only call when they want money back. The only way to stay in the loop before these 2026 deadlines pass is to be part of this community. Make sure you hit the subscribe button and turn on the bell, because once these windows close, your monthly check is locked in at the lower rate forever. Now, here's the part of the video I wish someone had handed me 15 years ago. The federal government built a parallel payment system specifically for federal benefits. It is called Direct Express. It is a prepaid debit card issued through Comerica Bank and managed by the U.S. Department of the Treasury. And in 2026, it is the simplest, cleanest, most consumer-protected way to receive your Social Security if you want nothing to do with the fee traps inside the big three banks. Direct Express has no monthly maintenance fee for the basic card. It has no overdraft fee because you cannot overdraft it. It has no minimum balance requirement because there is no balance requirement. The company cannot lend you money you do not have, so you cannot accidentally pay a fee for being broke. The card is accepted anywhere MasterCard is accepted, which today is more than 30 million merchant locations across the United States. The protection layer is the real gift. Direct Express funds are treated as federal benefit payments from the moment they land on the card. The same 2-month garnishment protection that applies to a bank account applies here, but the small balance and limited withdrawal structure means that most creditors find it much harder to attach. It is not bulletproof. Nothing is bulletproof. But it is a clean, simple, low-friction home for your check. To enroll, you call the number on the back of this card and go through a 5-minute verification with the Treasury's payment agent, or you sign up at the official Direct Express portal, the one run by the US government, not a third-party reseller you find in a search engine. You give them your social security number, your date of birth, and your direct deposit information. The Treasury routes your payment through them the next month. There is no waiting period. There's no paperwork mailed to you that you have to sign and return. It is built for the senior on a kitchen table timeline. If Direct Express does not fit your life, you have other 2026 grade options that are not JP Morgan Chase, are not Bank of America, and are not Wells Fargo. Credit unions, community banks, online high-yield savings accounts tied to a checking line at a small local institution. These smaller institutions are not perfect, but they are not running trillion-dollar overdraft programs. They are not signing federal consent orders for abusive fee practices, and they are not counting on your inertia to make money. Many credit unions now offer free senior checking accounts with no minimum balance, free direct deposit, and a real human being who picks up the phone when you call. Now, let me give you the protective action plan, step by step, in the order you should actually do these things. Step 1. Open your last 2 months of bank statements. Find every fee line. Write each one down on a single sheet of paper. Add them up. That number is the price your current bank is charging you for doing nothing. Step 2. Call the customer service line of whichever of the 3 banks holds your account. Ask them 3 questions. First, what is the monthly maintenance fee on my account in 2026, and what do I have to do to avoid it? Second, what is the overdraft fee, and what is the daily cap, and am I automatically enrolled in any grace period? Third, are my federal benefits protected from garnishment in this account, and does the bank use the 2-month safe harbor rule? Step 3, take your answers and compare them on paper. Put Direct Express next to your current account. Put a credit union next to your current account. Put any small community bank next to your current account. Look at the numbers. The cheapest option is the answer. Step 4. Once you choose where you want your check to go, file the direct deposit change with the SSA. You can do this online through your My Social Security account, by phone, or in person at any field office. The change takes about 1 to 2 pay cycles to take effect. While you wait, leave your existing account open. Do not close it until at least 2 direct deposits have hit the new home. That way you avoid the single biggest mistake seniors make during a bank switch, which is closing the old account before the new account is verified. Step 5. Set up an automatic alert on the new account. Every direct deposit should trigger a text message the moment it lands. If it does not land on the expected day, you call the SSA that same morning. You never wait 3 days to wonder. You never accept a maybe it will clear tomorrow. You call. I know this feels like a lot of steps. It is not. It is 1 afternoon of paperwork, and the return on that afternoon can be measured in hundreds, sometimes thousands of saved dollars across the rest of your retirement. That is a higher hourly rate than any financial advisor in the country charges a senior client. And you did it yourself, with a list and a phone. I spend my days tracking these codes because the SSA does not have a team dedicated to calling you and telling you how to save money. They only call when they want money back. The only way to stay in the loop before these 2026 deadlines pass is to be part of this community. Make sure you hit the subscribe button and turn on the bell, because once these windows close, your monthly check is locked in at the lower rate forever. I want to close with one final warning, because the threat is shifting under our feet in real time. Throughout 2026, there is ongoing federal discussion about tightening the rules on how banks handle federal benefit direct deposits. The direction of those discussions is more protection for the senior consumer, not less. But that direction is not law yet. Until it is law, the burden is on you. The protection you have today is the protection you fight for today. The bank is not going to fight for it for you. If someone in your family is a senior on Social Security, send them this video. Not because I need the view, but because the fee they pay this month is the same fee they paid last month, and the month before that, and the bank is counting on them never to ask why. Asking why is free. Switching is free. Telling the bank you are leaving is free. The only thing that costs anything is staying. Knowledge is your only shield in retirement. Do not let them catch you off guard. I'll see you in the next one.